Drop it.
Welcome to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, sitting here with my partner in crime,
Michael Becker of Sierra Pacific Mortgage.
Hey, Michael.
Happy Memorial Day weekend.
Happy
Brad.
Memorial Day weekend.
That's when we're
Michael.
recording this. This will drop a little bit after it.
Yeah, right. But yeah, it's a nice holiday weekend.
So far, so good.
Yeah, beautiful weather.
Perfect.
Yeah, can't complain. I'm a little morose though for two reasons.
Which?
Maybe three reasons.
Oh goodness. Do I have to be a psychologist today, in addition to being the mortgage expert?
Yeah. Well, so you hit the nail on the head with one of them. And we'll talk about it later, but rates are kind of annoying me right now.
Yeah, that tends to do that
Yeah.
to me too. But try not to. Don't let it ruin your weekend.
No. But then we the Texas Rangers have been
They're a good team this year.
sticking in my craw.
You know, it seems like the Orioles have been playing a lot of either. I think every series they've played over the last month has been with a potentially playoff-bound team.
Yeah.
It sure would be nice if the Oakland A's could come to town every week.
Wouldn't that be great?
Last I looked, they were 10-41.
Yeah.
But no, the Rangers beat us the first two games.
Yeah.
We win most series. You can't always. Although the problem is, we're in the AL East, and even the worst team in our division is over 500.
Right.
So it's very difficult to win the division, and even if we don't win the division, to get in the wild card race, it's gonna go down to the wire because there's so many good teams.
Yeah,
Every team's
yeah.
good, at least.
And speaking of teams, my last reason,
Okay.
May 31st, Doomsday, the last episode of Ted Lasso.
Now you're
drops.
gonna be upset. Well, maybe something will come out that. Although Shrinking was kind of positive, I really loved Harrison Ford's character in that.
Oh my gosh,
Ted Lasso.
That's such a great show.
Ted Lasso always does have such a positive
It does.
message.
It does.
Hopeful.
Yeah.
Like I was going to say, I've been waiting for a while. I don't know when it's going to come out, but the second season of Reacher, did you watch that? It was on Amazon. That's a good one.
Yeah, I like that too.
I like that. But
Yeah.
Anyway, so it is Memorial Day weekend.
Yeah.
So let's talk about how we do the show.
Well, yeah. So
What do we start with?
We're starting with the rundown. That's our market update and Michael's mortgage industry update, and then we roll into the scoop. And for this week's scoop,
It's perfect.
it's perfectly timed since it's Memorial Day weekend. We're talking about VA loans. So that's
And all the benefits that our veterans
well-deserved
reservists.
benefits. Yes. Yeah.
active or retired military and reservists have access to this wonderful program.
Yeah,
And we're gonna talk
absolutely.
about it.
So we're going to talk about that and pay a little tribute to our service people, and then we'll get into the Unreal, and
That's a positive.
It is a positive this
Often
week.
the Unreal is like, oh my God, what
the heck were they
I was
thinking?
just going to do what the and just let them fill in the word.
Right.
Let's just fill in the word. But this is actually a positive take, so it'll be interesting.
Yeah. I'm encouraged by this one, and then we'll run into the highlight.
You can say it.
The spotlight.
Spotlight.
Yes, where we highlight a local business.
We're getting outside of the Baltimore area for this one.
We are, which is good. I feel like I haven't paid as much attention to enough attention to some of the surrounding areas, and so we're gonna spread out a little bit more. All right. So Michael.
Yeah, mortgage application and mortgage rate data.
Yeah.
For the second straight week, we've seen mortgage applications drop. Now, this is the application survey for the week ending May 19th.
Mm-hmm.
Next week I'll be reporting what kind of happened this week, which probably isn't going to be good either.
I can't imagine it's going to be great.
Second week in a row, we've seen declines in mortgage applications, 4.6% decline in mortgage applications for the weekend in May 19th, 2023.
Mm-hmm.
2 weeks ago, May 5th, that week ending, we saw 6.3, but then it was followed by a 5.7, then a 6.4. Kind of makes sense because rates were looking pretty good the first week. Actually, till on the 10th or 11th of May, and then
Yeah.
it's been since May 11th that every day. It's been a weird run, 11 straight days of flat or worsening pricing for mortgages. It usually doesn't happen that way. We've been in an up and down market, 2 days up, 2 days down, that
Yeah.
kind of thing.
Too many up days.
Range bound, right?
Yeah.
We were range bound, so.
Yeah, and going over that 7% marker
Well,
that's a little painful.
Yeah, the mortgage application, the MBA survey had an average rate of 6.69. Now that, again, this is for the week ending May 19th, and that's about right. Mortgage News Daily is who we use for daily updates on rates because they update it every single day.
Yep.
When it comes to mortgage rates, they're at 7.12. They probably were around 6.69, 6.7 May 19th because we've probably risen 3/8 to 0.5% in that a week since then.
Crazy.
In 2 weeks, we probably saw an increase of 3/4 of a point in mortgage rate, maybe 7/8. Not quite a point increase in rates, but just under.
Yeah.
And that's a pretty big. And it's all. It's hard to. What it is it's a combination of Fed speakers saying the fight against inflation isn't over, concerns about inflation not being over, the PC index, personal consumption expenditures, which is the one the Fed looks at.
Yep.
The headline number actually dropped, but the core actually increased month over month and year over year to 4 point. The year over year core PCE, which strips out volatile items like food and energy, saw a slight increase. There's a lot of people out there saying there's some lagging data when it comes to rents that'll hit it and slow it down, and at that point, the Fed may feel okay because I'd say 2 weeks ago everybody was pretty sure the Fed was going to pause in the June meeting and see what happens because of the bank failures.
Yeah.
And we haven't had one of those in a while. So now they're back talking about inflation and employment. The jobs report comes out next Friday, June 2nd.
That's going to be an important one to watch.
My birthday.
Yeah. Happy early birthday.
Thank you. And it'll be very important. If you see a slowdown and hourly earnings don't climb as much or that tends to soften, that'll be a positive for rates. My concern is the debt ceiling is going to be solved, it looks like, soon.
Yeah. Well, they reached a tentative agreement. Has to pass the House and the Senate.
It will get resolved one way or another. We've never defaulted. And the problem is that the systems with the federal government are so antiquated, they can't prioritize payments. I read an article about that. They just can't. They've never done it. They can't do it. They just send it all out.
Yeah.
So, and there's never been a default or a interest payment delay except for 1979. I think there was something to do with wires on short-term treasuries, and there was people weren't getting their interest payments from the treasury.
Okay.
It was something real short-term that they fixed, but because of us not raising the debt ceiling, we've never not paid the interest, and that would make financial markets all haywire because everything is so interconnected.
Yeah,
in the financial
absolutely.
market. So I don't think that's going to happen. But the bottom line is, I think, sadly, Brad, as sad as or as morose as you are, the short-term outlook is maybe even a little higher on interest rates because once the debt ceiling gets solved, that's a risk on. There's bond market's going to have to figure out how much more treasury issuances are going to be out there because we haven't been selling them because we've been up against the debt limit. So anytime there's added supply, it tends to be a negative for rates. But that's the short term.
So next week I'll be prepared to speak with my Eeyore voice.
Well, when we get
bother.
Well, I'll tell you what. If you're looking at it for a house, wait till we get to the unreal and then decide whether it makes sense or not.
Absolutely. Absolutely.
All right, that's my take.
All right.
You're up.
Yes, I am. All right, so we're looking at the last 7 days in the Baltimore metro area, and we had a fairly big change in the active listings to the negative, which is not the direction we want to see, especially this time of year when we're starting to see more and more listings usually come on. Week over week, we're down almost 20%, 19.89%. Pending sales was up 13.32%, though. And this is not a surprise, really, because you think about it, nobody wants to bring their house on right before the holiday weekend when everybody's out of town going away. It's a bad time to bring your house on the market. Now, out of necessity, sometimes it happens, but you see very few homes go on right before a holiday where people are going to be boogieing to the beach. So it's not shocking. I would expect to see that number tick up again probably as early as next week. So anyway, Settled properties was down 9.21%. Off market down 2.72%.
Not a big deal.
The average days on the market still ticking down.
Wow.
3% down. And the median is flat, 6 days on the market. So
Is it possible for days on the market to go negative?
well, yeah.
Because people, before it ever gets listed,
It's happening quite often, as a matter of fact, because they're sight unseen offers, right? They come coming soon. There's no tick off. It doesn't tick up on the days on the market, and so you get enough coming soon properties that
that's why I said
get sold before. Yeah, absolutely.
Because I know people who get they do everything they can before a listed property is to try and get an offer accepted.
It's a little dangerous, the sight unseen, but yeah. But anyway,
I'm sorry.
All right, that's all right. It's funny though, but yeah. All right, so total volume's down 9.1%, and the number of concessions is down about 19.5%. The percent getting concessions. This is not surprising given the fact that inventory was going down 2%. Getting concessions dropped 11.34%. And the average concession, though, ticked up just a bit, about 5% up. Okay. The average list sold, excluding auctions, went up 0.03%. So we were at 100.89 last week, 100.92 this week. So again, people are paying over list price. And
lots of offers. Those nice houses are almost always getting over list.
Yep.
In a competitive market, that people are bidding up the price.
Yep. And the median sold price went from 2.7% up from 370 to 380. Now, the showing activity. That's something we've been tracking more recently because it's a little bit of a leading indicator for us.
Well, it would kind of go along with mortgage applications.
Your mortgage applications, and these are the week ending May 21st.
Okay, a little bit, just a couple days after mine.
Yeah, these come from Bright MLS, and so we don't get. I can't pull the day to the date numbers that I can pull for the rest of the things, but showings are up week over week about 14.3% for last week. Now, that doesn't surprise me at all because people will still look and get under contract right before a holiday, but they won't typically list right before the holiday. But still down 11.2% year over year. So we still have a little bit to make up. But if you look at the showing activity, and I've been saying this every week, except for 1 week of the year, we have been trending above the 2019 kind of last normal market for the entire year. Okay. So we've been ahead of 2019 in showing activity, and we continue to slightly eclipse those numbers. So anyway,
if you were to bottom line this data, it's the story continues that there's limited inventory, plenty of demand, and not enough supply.
Right. So sellers are still going to benefit. Buyers are still going to have to be aggressive with their offers. They're going to have to likely offer over list price for any of those HGTV ready homes.
Yes, sir.
But if you have any more questions on this, you know how to reach us. So, all right, Michael.
Yes, sir.
When we come back, we're going to bump right into the scoop.
Sounds good to me.
We're going to talk about those VA loans. So, back in just a sec.
Try it.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, sitting with
Michael Becker of Sierra Pacific Mortgage.
So, Michael, this episode, as we discussed in the intro, is very aptly timed for Memorial Day weekend.
Yes.
We're recording on Memorial Day weekend, and our episode is focusing on VA benefits, home buying for our service members.
Yes.
And that's a great loan program. And I think sometimes it gets a black eye that it shouldn't get.
From whom?
From the seller listing agent.
People who are afraid of. First of all, I want to say thank you for your service to our reservists.
Amen to that.
And current and ex-military.
Yes.
So it's something they've earned.
Absolutely.
It is hands down the best mortgage product
Yeah.
out there.
Yeah, absolutely.
Not everyone's qualified. You had to have served, be a spouse of someone serving to qualify.
Yep.
A surviving spouse
Yep.
of someone who served
Yep.
can also take advantage of this product. So, yeah, they shouldn't have that attitude. But in today's age, you're exactly right, and I think it has to do, and we'll get into that.
Well, and that's why we need to have this episode, because we need to educate the public.
It's not that you should be accepted, because guess what? Somebody might be able to, because of all the benefits of a VA loan, that VA offer, even though it has 0% down, may be able to handle an appraisal gap.
Yeah.
May be willing to go over list more so than somebody with a conventional loan.
Absolutely.
So think about that before you
dismiss it.
poo-poo
Right.
away
Right.
a VA offer.
Yeah, absolutely.
So we have a number list. I mean, I'm not going to they're numbered in this article we printed out to kind of go over. We're not going to number them or read out the numbers.
Right. Yeah, but
to start, this is
the biggest. It's the biggest.
The biggest benefit, and let's get right in there. These are the benefits, and the biggest benefit of a VA loan is what?
No down payment.
No down payment is required. You can put money down.
You can put money down, right? Sure. But you don't have to.
You do not have to.
And that can save somebody significant money. One of the reasons why people sometimes delay home ownership is because they're saving for that down payment. And if you have to put down 3.5 or 3 or 5% or whatever,
correct,
that can delay your purchase.
Yeah,
well, with this VA benefit, you don't have to do that.
Well, look at the numbers right there. If you have 5% down on a $350,000 mortgage, that's $17,500.
$17,500 that you don't have to come up with right now.
$450,000 mortgage, $22,500.
Yeah, yeah, and that's huge.
Absolutely, it's huge, and it could say it's like you said, it's the hardest thing, and I'll say
and
this
now. That doesn't
now.
mean that they're a bad buyer because they don't have.
I have buyers who have $100 or $200,000 down and still want to put 0% down. We'll get into that about the funding fee a little bit later,
right?
But it's because they don't have to. They'd rather preserve their cash,
hold on to the cash
for investments, for after they buy the house.
Any number of reasons. Yeah, absolutely.
Absolutely. All right.
Yeah.
Number 2, and I think this could be number 2. I said I wasn't going to number it,
but I like this benefit.
Yeah.
I like this benefit a lot. No private mortgage insurance, no PMI, no MIP that you see with a lot of the other. When you fail to put down 20% on a loan, normally with other loan products, you have to pay mortgage insurance.
So I'm going to go through the list of products out there.
Yeah.
Conventional financing, less than 20% down, always has private mortgage insurance. That a monthly amount of mortgage insurance varies depending upon the number of borrowers, the credit score, loan to value, and product. It can be It can be if there's 2 borrowers, you're doing Home Ready, Home Possible. A great thing for people.
It can be
80% of the area median income can be pretty low.
Yeah.
FHA loans have mortgage insurance premiums, MIP.
MIP.
Same thing. They have an upfront factor that's 1.75 that generally gets rolled into loan, but there's also a monthly factor of 0.55. That's, that's going to be over $200 on a median priced home per month.
Yeah, yeah.
USDA. Now the USDA is a loan that allows 0% down, but it has a funding fee that gets rolled into the loan similarly, and they have a funding. They call it a funding fee, but it works essentially the same as a mortgage insurance premium, and it's 0.35.
Right.
So over all these every program out there, you're going to save per month. Now, with a VA loan, you and I talked about it, and there's another topic about it, but a 720 score for a VA lender borrower is probably where you're going to get the best rate. You don't need a 780 like with a conventional loan.
Right.
So
that's the threshold.
Yeah. So I looked up for a $350,000 loan. A 720 score, and a single borrower.
Yeah.
The mortgage insurance premium would be $200, around $200 a month.
It's a decent amount of money saving.
$2,400 a year.
Yeah.
But if you look at it from the other aspect, as far as purchasing power.
Oh yeah, what's it going to allow them to buy?
It's like $33,000. This is a given rates these days. Higher rates. If rates are lower, it gives you even more purchasing
and that
power.
could mean the difference between getting into the area that you want or have the features that you want in the home. So yeah, absolutely. Yeah, so that's a huge benefit.
It's a great benefit not having to pay.
Now there's another financial plus too. Interest rates. competitive interest rates.
They have government loans, because they're backed by the government, tend to have better interest rates. I'm talking FHA, VA, and USDA
right.
loans. That all tend to have better rates than conventional loans. And specifically, this article I mentioned is 0.5% to 1%.
Yeah.
I would definitely say it's easy to get 0.5%. It could be 1% or more better if you're somebody with a 680 score who doesn't qualify for Home Ready or Home Possible on the conventional side.
Right. You're going to get really dinged on those rates.
The differential in the rate is going to be huge.
So let's say it is a 0.5 point reduction.
Okay.
On that $350,000 loan, over the course of the life of the loan, it's $34,200, and if it's a point, it's 1%, $67,320.
Wow. And this would apply over the life of the loan, because what if somebody said to you, what if you refi? Well, yeah, if you refi and you're in a VA, if you're going to refi a conventional loan, you're going to refi
in a VA, right?
Because it's got one of the easiest refinance.
More streamlined.
It's called an EARL.
Yeah.
Do you know what EARL stands for?
I don't know. I mean, I love the name, but
but it's an EARL with an I.
Yeah.
IRRR.
Yeah.
Now. Yeah. Interest rate reduction refinance loan. So
there you go. EARL. Yeah. But it's great.
Or what? That's
Earl Scruggs, less flat. No.
Well, or if you're from Baltimore, it's what comes out of the ground. The black old.
Right. Earl. You got some Earl leaking on your car. Yeah.
I'm sure we have Baltimore
Too
accents,
funny.
even though
Too
we
funny.
don't think we do. When I hear myself,
every once in a while,
it comes out.
Yeah.
Absolutely.
Yeah.
All right.
We should do. Actually, you know what?
What's that?
That's it. We're adding an episode on Baltimoreese.
Just do the whole episode.
We're going to do the whole episode like that. No, maybe that'd be a little much, but we should do. We're going to do an episode on that. All right. So now, next benefit: relaxed credit requirements.
Right. You still do have to qualify.
Yep. Mm-hmm.
You have to have a credit score, decent credit score, but it's much lower. Many lenders will go down to a 580 credit score with a VA borrower. There's lots of things I'm thinking of that comes to mind. When it comes to student loans that are in forbearance, they have a pretty low calculation. Basically, you add up all the student loans, multiply it by 5%, and then divide that by 12, and that comes up with your monthly payment that you have to get hit. I had somebody with $300,000 in student loans, and it only was a $1,250 a month payment to their debt-to-income ratio. Speaking of debt-to-income ratios, automated underwriting comes into play, and you'd be surprised at how high of a debt-to-income ratio you can get a VA borrower. I've had a VA borrower get approved for a 62% back-end ratio. You'll never get that on FHA.
No, not even close.
57 is about the highest on FHA, and 50 is on conventional loans. And USDA is like 43% is pushing it.
Yeah.
So they're the most restricted. The reason is, now that sounds like a high debt-to-income ratio. People might think that it's a risky loan, but there is a residual income calculation that gets done with a VA borrower. So somebody with a high income, I've often said this, I've always thought that debt-to-income ratios were kind of weird for high-income borrowers. If you're a high-income borrower and your debt-to-income ratio is 60%, let's say you're making $20,000 a month, right? The amount of residual income is pretty great. There's only so much you could spend on the necessities of life, the BG&E, the food, the gas, things like that aren't included in your credit, in your credit report.
Right.
So it kind of makes sense. Now, somebody pushing a 57 or 60%, let's say a FHA, a 57 debt ratio, who makes $3,000 or $4,000 a month, there's not a lot left over to pay for the necessities.
Yeah.
So that's an important factor. Not only do the relaxed credit things allow higher debt ratios, the turnaround times for major derogatory events, if something bad happens in your life, a short sale or foreclosure, they're much shorter than they are on conventional loans, about half in most cases. And if there are extenuating circumstances, they can be even shortened even further, meaning something happened in your life that resulted in a short-term loss of income, a death of a spouse, which can happen in the military, or a loss of a job post your military service. You get a job, you're working for a while, and then you lost it. Those things, that's part of the relaxed credit requirements. They An underwriter once said to me, she had been instructed to do everything. You have to follow guidelines, but to do everything you can to qualify.
To help qualify for
a borrower.
Yeah.
Absolutely right.
Yeah.
Absolutely right.
Well, and they tend to be still some of the most successful loans. So
that's a great point. I brought that up to you. I had researched that for the thing, for this show, and I was surprised because you would think with the higher debt to income ratio and the higher loan to values, those are generally predictors
could be a big default issue. Yeah.
Those are usually pretty big predictors of default rates, and they actually have very, very low default rates. So that might be why investors don't mind buying the mortgage-backed securities that help fund these loans.
Yeah, yeah. All right. So next benefit?
Yes.
Closing cost limits.
So I scrubbed out limits. I mean, there's a couple things the big thing is, one of the reasons we talked about it was the termite thing.
Yeah, that was introduced in 2022. The
Normally,
the VA buyer
prior to that
was not allowed to pay for the termite inspection, the wood destroying insect inspection for the property. Also, we're not allowed to pay for any of the repairs for any termite related or wood destroying insect related damage. Those rules were changed by VA in 2022 so that now they can pay for that. And so that's one thing that's kind of an important thing for sellers to realize, because I think that mentality's been out there for so long, and they think, it would cost me more if I have a buyer that comes in with a VA loan.
Because there's a pest or termite inspection, and if there's repairs required. But truth be told, don't you still, in a conventional loan, still have that? Or if your home inspector sees any evidence of it?
Well, so now, though, the contract, when it was rewritten, the contract was rewritten to be an as-is contract, which means there's no longer any requirement for any termite-related damage to be paid for by the seller, unless it's negotiated with the other terms in the contract on the property inspections addendums. So that requirement's gone.
Okay.
Yeah, but it's important. So, but there's some other things that relate to closing costs that are...
Well, there are limits, and it's more about knowing about closing costs and what can be paid for by the seller on this. So, closing costs, 1% origination fee is the most the lender can charge. A lot of lenders, some lenders, that they charge a 1% origination fee. I generally don't tend to do that. They can pay discount points to buy down the rate, but a loan origination fee is capped at 1%.
Yep.
And the other big part is paying any of the buyer broker fees.
Right. So typically a buyer brokerage is going to have, whether they call it an admin fee or a whatever kind of fee, but there's typically a $400 to $600. Maybe sometimes I've seen them even higher. I've seen $1,200, and for some brokerages, we are much lower than that. But they typically have a brokerage fee that goes along with
a VA buyer cannot pay that fee.
Correct.
So it either doesn't get paid or the seller.
Right. So the lender charges a little bit less. The realtor charges a little bit less.
Right. And now, when it comes to, in the good old days, before it became such a seller's market, most VA buyers who qualify for 100% financing often could get them into the home for very little, if nothing, out of pocket.
Yeah.
In fact, it was my goal to see if I could get somebody their earnest money deposit check back and close it. Literally, you could put, let's say you're buying a $300,000 house, you put 1% down a $3,000 check.
Yep.
The seller can pay up to 4% of seller concessions to handle regular recurring closing costs and prepaids. Mm-hmm. They also can pay up to 2% in discount points if that's standard in the market.
Yeah.
So you could buy down the rate if you want it. If this was a period of low interest rates and it was more of a balanced market or even a buyer's market, you could often buy down the rate. It's a great thing because guess what? Not only do they get a lower rate and the seller paid for it, but you get to write those points off on your taxes.
Yeah, which is huge. And then you get a check at settlement.
So you get a check at settlement. One last thing about closing costs, I think it bears mentioning now, is with the funding fee.
Yeah.
So there is no mortgage insurance, but a funding fee. It's an upfront fee that's charged, and it's based on the type of loan that you do and how many times you've used it. So for a purchase, first time use, 100% down, or 100% financing, 0% down, 2.15%. If you put 5% to 9.9% down, 1.5%, and if you put 10% down, it's 1.25%. Not big. They used to be a big differences between that, and they used to have differences between reservists and active duty or retired military.
That's all flattened out now.
Everything's the same.
Yeah.
Subsequent use. If it's your second use of it, because we're going to talk a little bit about another benefit where people might subsequently use a VA thing. If you do 100% financing, it's 3.3. So that's a big spike. So if you're somebody who's going to be in charge of the funding fee, you might want to look for a down payment if you can.
Right.
But with 5% down, it's again 1.5, and 10% down, it's 1.25%. So there's no increase on that. When it comes to a cash out refinance, first time use is 2.15%, any subsequent use 3.3, no matter what the loan balance is. But that is a benefit of a VA loan in that you can go to 100% of the value of your house and take the cash out. But that funding fee is an expense, so there better be some savings out there if you're doing it. If you do what I mentioned earlier, what we in Baltimore call black gold, Earl. If you do an Earl, an interest rate reduction refinance loan, the funding fee is very small. It's 0.5%.
Yeah.
Now, guess what? If you are rated disabled in any way, at least 10% disabled by the VA,
No funding fee.
on any of those things I mentioned, if you have that, that is a humongous benefit. It's well earned, in my opinion, if you're disabled.
Yeah.
But what a great benefit. So those are things you weigh if you're a veteran. You have the benefit when you're doing a refinance or things like that.
Yeah.
But it is pretty inexpensive to do an interest rate reduction loan.
Yeah. So now you alluded to this when we were just talking about how you can use this benefit more than once. Sometimes people believe, oh, it's a one-time deal, but I use it and I'm done. No, it's a lifetime benefit.
It's amazing. You can use it multiple times. People think you can only have, like with the FHA, you can only have one FHA loan at a time.
Right.
I got to get a little closer to the microphone. I can hear myself pulling away, so I'll say it again.
Thank you.
With FHA, you can only have one. You can have multiple ones over your life, but you can't have more than one at a time, except in some rare exceptions. I'm not going to get into that.
Right.
With the VA, you can have multiple loans.
Yeah.
It all comes down, and how much you can borrow depends on how much of your
entitlement
or eligibility, how you can do it. But let's say you bought a reasonably median priced home, first time with a VA benefit, you decide not to sell it. You may be moving, you're either in the military, maybe moving to another base, or maybe you have a post-military job with the Department of Defense or a contractor, and they want you to move across the country or something, and you're going to be there for a while. You don't have to sell that home. You could turn it into a rental property if you wanted.
I'd keep that VA loan.
Right.
Yep.
And let's say you bought a $350,000 house or so, and then you wanted to buy a $700,000 house. Well, you've used up some of your eligibility, but you could probably buy that $700,000 house with about 10% down and use the VA loan for that. There's a calculator that I can share with anybody who's interested. I shared it with you, Brad.
Yeah, we'll put a link in the comments.
Okay.
Yeah.
That helps you figure out how much you know, but it's a huge benefit. Not only that, I've had somebody who was a veteran who, when I came across him, it was one of those things when the housing bubble, a lot of people weren't doing government loans, VA or FHA loans, when there's so many other loan products out there. Everybody kind of got away from government loans.
Right.
He sold his house and moved to another state, and when we were helping him do the VA loan for the new purchase, I pulled a certificate of eligibility, and he had some eligibility used that was never reinstated. Now, it should have been reinstated, and there was an error. The good news is he had enough eligibility to buy this house that he wanted with 100% down because he only used a little bit of his eligibility.
That's fantastic.
And now he's in the process of getting that reinstated. It had to do with a foreclosure and things like that long time ago. But people who, if you do sell a house, make sure you apply to get your VA reinstated. If I'm doing a transaction where you're selling a house and buying a house, I can help you get that through the VA portal, how to get your eligibility reinstated.
Beautiful.
But it's a great benefit that people you could literally buy 3 houses with VA loans and put small down payments on all of them, and you probably have enough eligibility to do that.
Right. Right. All right. Now, another benefit, no prepayment penalty. Now,
that's not a big thing.
It's not a huge thing because most loans don't have a prepayment penalty, but it's a good point. No
It
prepayment
can't be a
penalty.
qualified mortgage and have a prepayment penalty on it. So
Right.
a lot of those debt service, related loans where people are based on the rent rolls are doing it, and it's not a qualified mortgage because they're not using regular income. They may have prepayment penalties
Yeah.
on them.
Yeah.
So, but no, the VA doesn't have any prepayment penalty at all.
Yeah, good. All right, the next benefit is foreclosure avoidance.
Mm-hmm.
Yeah. Now, and you mentioned this earlier
Yep.
too, they're some of the safest loans out there.
8 out of 10 home buyers with a VA product don't put any money down. That's
Yeah.
amazing. I mean, and some may be able to, some may not, but they haven't had to do it. And it's such the guarantee program isn't just about getting them into it. It's how to help them get it into loan. I
And
would
stay in the home.
Well, the VA also, let's say something happens or you have to move. The Veterans Administration is great at helping people avoid foreclosure.
Yeah.
Forbearance procedures.
Yeah.
They'll help them to figure out how to keep the house. Nobody wants to see a veteran lose their home.
No.
And as I said earlier, they perform incredibly well.
Yeah. Yeah. Very good. All right.
This is a big one. We're probably going to talk a little bit more about in this section, but the VA appraisal.
Right. Right. So the appraisal serves two purposes. It establishes that appraised value of the home, and then it also and this is the case for many of the government-backed loans. It makes sure that the home meets the minimum property requirements. And if you're in the military, that's called MPR because you have to have an acronym for everything in the military. So that it's
I have one coming up.
Yeah. So the MPR, well, you could talk about, when they get the change of duty. So if you PCS across the country, so there's an acronym for everything, which is good. Actually, it's kind of fun. But you could litter a sentence. I remember speaking to my dad once, and we were talking about military lingo, and I think he strung together like 10, 15 different military acronyms in one sentence. And I was like, but I understood it. So anyway, but yeah, so making sure the property is fair market value and making sure that it's safe for the veteran or the service member to move into. And so they're going to look for things like health and safety issues, right? Do we have the railings in place, peeling, chipping paint, asbestos or things like that? Anything that could cause a health and safety issue.
We mentioned a little bit earlier, and the thing that you didn't just say there is, or did you say it? It goes to the local county. Like they're looking out for that.
I didn't mention that, but that's a good point.
So FHA has very specific guidelines.
Yeah.
A VA appraisal is going to be somebody. So the VA appraisal. What's different about that process and the regular one is you do not go to an appraisal management company. Mm-hmm. We go to the VA portal and order an appraisal for a VA appraiser. It gets assigned. It's generally somebody local. It should be somebody local because the safety and security issues that you were talking about.
Mm-hmm. It's all based on county code.
Correct. So it can be different from one county to the next, and that appraiser should know that. So people worrying about a potential repair or subject to appraisal may not have to worry about it. And as long as their house was built to code, there's probably nothing that has to be repaired.
Yeah, yeah.
So that's what I wanted to mention.
Yeah. So it doesn't have. Sometimes I think that's one of the other reasons why sometimes people shy away from the Govy-backed loans. Mm-hmm. They think, oh, there's going to be these horrible inspection contingency issues, and not necessarily the case.
Right.
Yeah.
Absolutely.
Yeah. Okay. All right. So, Michael.
Yes, sir.
Acceptable income's another huge benefit.
Well, that's huge, and here's where I was going to throw in the new. Do you know what an LES is?
LES.
Mm-hmm.
What
it's
is it?
Leave and earnings statement. That's what you get.
Yeah.
So when I'm doing a VA loan, so acceptable income. There's verifying income is a central step to the VA process. Lenders want to make sure the prospective buyer can comfortably afford it, their new monthly mortgage payment. Many VA lenders accept multiple forms. All VA lenders accept multiple forms. It's interesting, and there's a lot of things that people don't think. Right. So if you're doing a VA loan and you look, first of all, you got to learn how to read an LES, leave and earnings statement. Their base income is not all their income. There's lots of different types of income. There's housing allowance, there's clothing allowance, there's food allowance, there's things like that can go in to helping you qualify.
Hazard pay, overseas pay.
If you're disabled, you're going to get disabled. A lot of times, one of the things that you must ask when you're doing a veteran, right? Because a lot of them move on to other jobs. Even they still get some disability
Yeah.
pay. They may not get a pension, they may not have served long enough, but if they were disabled, and they may get some disability pay, but they still work. And a lot of times you'll forget to use that disability income, and that's something that can help them qualify. Retired military tend to have pretty good pensions, so you don't forget to use that. And it's a lifelong income. It's not something that you got to guarantee that there's a continuance for 3 years like other types. Active military, unless you're an officer. It's the other thing about an LES statement, Brad.
Yeah.
Military dates. It's backwards from
Oh,
the way
right.
you look at
Right.
it, and you can make a mistake because the reason you're looking for it is when their service is up,
Right.
And if it's within a certain period of time, you have to get something either from they either have to re-enlist, or you have to get something from their base commander saying they plan to in order to use that income if that enlistment is ending. But it is very different than the way we regularly read dates. So it's something that you should be aware of, and I would probably familiarize myself again, because I remember looking at it saying, your enlistment's going to end real soon. No, that's not how you read it.
Right.
So anyway.
Yeah. All right, so what's the next one?
Variety of VA loan types. Now, there are some variables with it, but I mean, you can get fixed and variable rates. For example, there are energy efficient loans with it, which is a great way to get some upgrades. And there is a VA rehab loan, but that VA rehab loan is generally just cosmetic and caps you at $35,000 in repairs.
Right.
So there are some varieties of it, but in general, most people are going to use a standard VA loan.
Yeah.
Okay.
Yeah.
Interest rate we're at a time where rates are high. Okay?
Right.
Most people think they're going to come down. They're not going to. They may go up in the short term, but eventually higher rates will slow the economy. Fed will be forced to cut. Slowing economic activity generally is positive for the bond markets. As bond prices go up and their yields come down, mortgage rates come down.
Right.
And at that point, people look at the benefits of refinancing. And refinancing a VA loan is very, very easy. No appraisal needed. Just need to verify employment. Don't have to verify income, no debt-to-income ratio. Now, the one thing you must know is it has to be 210 days from the note date of the loan that you did, and you must have made 6 one-time payments to qualify it. Other than that, we'll look at your credit score to make sure, and you'll get a rate based on that as long as that hasn't dipped greatly. It's a pretty easy loan. So if you're using a VA loan to buy a house right now, there's a pretty good chance you're going to be able to lower the monthly payment. Again, the funding fee on that is only 0.5%, and if you're disabled, there's no other. So with no appraisal, and most lenders charge a reduced application or administration fee, whatever they call that up front, instead of it being $1,000 to $1,300, it might only be $500 to $700 to apply for that. So that reduces the closing costs as well. So with no appraisal and a reduced admin fee, you're probably saving $1,000 on the refi. Now, for those who like to tap in the equity of their home, whether to fix it up, whether to pay off other high interest debt if you went through a bad period and you're using credit cards, or you have some other use of that and you want to tap in the equity in your house, there's the VA cash out. It does let you go to 100%. Now, if you use the subsequent year, the VA cash out hit is pretty high, so there better be some benefit to it. And of course, unless you're disabled, then there is no adjustment for a cash out refi. So I kind of wanted to mention those. I forgot.
No, that's great.
All
That's great. All right. So
this is a big one.
big benefit, no loan limits. Yeah. And they used to be in place, but they removed the loan limits a few years ago. So now, if you have your full loan entitlement, you can borrow as much as you can afford, as much as you can qualify for.
Correct.
Yeah, without the need for that down payment.
Not at all. One thing that needs to be mentioned is there is different pricing out there. Below the conforming loan limit for the county in this area, it's $726,200. You have one set of rates. Above that, it's called a VA jumbo loan, and those rates tend to be a little bit higher, pricing a little bit higher. However, myself and many lenders like me do cap our compensation. So the larger the loan amount, the less
your percentage is.
Right.
Yeah.
Or the better the pricing would be. So, so a $1 million loan might have the same pricing as a $500,000 loan. Now, a $750,000 loan might be priced a little worse than a $726,000 loan.
Yeah.
Just saying.
Yeah. Now, if they have some diminished entitlement available, right? If there's still some loan limits that come into play, right?
Yeah. Well, they'll have to look at putting, if you've used it and you haven't reestablished your eligibility, you will have to put some down. But you'd be surprised. It's in many cases is less than 20%.
Yeah.
I gave an example. You and I were playing with that eligibility calculator. I think we started with a $400,000 loan, and somebody was going to have to put about 12 or 13% down. They bought a house, 100% financing, $400,000 down. The next house is $700,000. They had to put 12, 13, 14%.
It wasn't a
$90,000
shockingly high number. I mean,
on a $700,000 house, they had to put $90,000
less than 20%. So
right.
yeah,
exactly.
Right.
Well, here we go. Funding fee exemptions. We kind of hit on that already.
A little bit, yeah.
But if you're disabled, you do not have to. Now, it does make sense, the VA funding fee. I guess that the funding fee is kind of like a mortgage insurance premium. It goes to it's a fund that helps pay for foreclosures or loans that do default, even though the default rate's pretty low with veterans loans. So veterans exempt from paying the funding fee to include, this is interesting because there's one on here that we didn't talk about. Veterans who receive compensation for service-connected disabilities. Veterans who would receive a disability compensation even if they didn't receive retirement payment. It's on your certificate of eligibility. It gives you,
right.
Generally it's in 10.
COE.
Yeah, certificate of eligibility. Yeah, very good.
Another acronym.
And they'll give you a percentage of disability. You must be at least 10% disabled.
Right.
You could be 60, 70% disabled. They'll do it. Veterans rated as eligible to receive compensation based on a pre-discharge exam or review. Veterans who can but are not receiving compensation because they're on active duty. So you could be active duty and still considered disabled.
Yeah, right.
And because you can still do your job, but you're still there's a percentage disabled doing it.
Right.
The last two I thought were cool. Why don't you read them?
Yeah, so
that?
Active duty Purple Heart recipients.
No funding fee.
No funding
Don't have
fee.
to be rated as disabled because that disabled process may take a while.
Yeah.
So someone who gets a Purple Heart immediately,
yeah,
you were wounded in duty.
Yep, you get a pass. Very nice.
Here's your no funding fee.
And the other one that's really nice, you get a pass, surviving spouses.
Yep.
If they're eligible for the VA loan, no funding fee for them either.
If their spouse gave the
ultimate sacrifice.
There you go. That was the term I was looking for. Thank you so much.
Yeah.
All right, here's one that you like, and it's you've
I do
talked
like
about
this.
it in the past because of where rates are these days. And if somebody has a house to sell and there's a VA loan on it,
yeah, and especially if they didn't put down any money, pretty good chance that there's a higher loan balance on it. So it may be a little bit more affordable for somebody to assume that loan. So assumability is another benefit. Now, if you're this is the surprising thing. If you have a VA loan, you don't have to have a VA buyer assume the loan. You can have a non-VA buyer assume the loan. That means any John Q. Public or Jane Q. Public can assume that loan and get the interest rate that you have now. Now, there's a reduction in benefit for you because if it's a non-veteran buying that property, then it still chews up that portion of your eligibility.
Correct. So if somebody assumes your loan and they are not a veteran, you can't get that part of your eligibility used reestablished, so you have limited eligibility moving forward.
But there's still some, and we talked about that a little earlier.
And the idea behind it is it's a great thing. It's a great selling point for a home because the interest rates that may be so much lower than they are now.
Yeah.
One thing people have to remember about assumability, a couple things they're going to have to cover.
Yeah.
The difference between the loan balance and the sales price.
It's got to be made up in cash or another loan.
Yep. And also closing costs.
Yeah.
Which you'd have to
have that anyway.
Have to pay that anyway. But remember that you're just not assigned, unless, well, no, I can't, there are going to be closing costs involved with it or title fees and such like that. But they're not. Remember, you're going to have reduced closing costs. So you're just assuming a loan. There's a little bit of fees associated with having a loan assumed. The person assuming a loan has to go through a little underwrite. They got to qualify.
Sure.
Right. You just can't. Somebody can't walk off the street and they're not going to look at your income and credit and say that. So.
Right. Absolutely. Now, if they are a qualified veteran, though, they and they buy the property from you, all they have to do is sign this substitution of entitlement.
Yep.
And then you can get the full entitlement back.
And that would probably make, I bet a lot of assumptions are being made in military towns around. Because somebody moves, they may be deployed somewhere else, and there may, especially with the long-term enlisted men and officers who make pretty good money, and they may be deployed somewhere else or be moved to another base or another department somewhere, right, or another specialty.
Yep.
And that house is there. I mean, it's a military town, you know. I would imagine assumability happens a lot these days.
Yeah.
So,
Yep.
Anyway, that's our list of benefits for VA buyers. They're very long. It's a great product. Anybody who's out, if you're a veteran, do everything. In fact, if I find out you're a veteran, I would insist upon using your veterans benefits.
Yeah.
I had somebody who was a physician and was asking about physician loans, which are a great product out there.
Can be.
But the VA loan was so
Better.
much better.
Right. Still saves them some money. Yeah. All right. Well, Michael, thanks. Great information. So again, we want to say thank you to those who have served and are serving.
Those who made the ultimate sacrifice.
Absolutely.
This is Memorial Day.
Yes. So remember and honor those who have delivered that service for us. And we thank you so much. All right. Michael, when we come back, going to get into the unreal and then the spotlight. So we'll be back in just a sec.
Try me.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long and Foster.
Joined by the guy talking who talks over Brad.
Sometimes, but that's okay. I talk over you too.
I gotta stop doing that. I'm Michael Becker of Sierra Pacific Mortgage.
I have to say, it's not a sign of disrespect.
No,
it's more a sign of maybe ADHD or something.
Or enthusiastically wanting to get your point across.
Yeah. But anyway, Michael.
Yes, sir.
So, moving into the unreal.
Yeah, often our unreal segment, we talk about stuff that's crazy or stupid or weird or things that somebody did that we didn't like.
Right. This is
was
different.
This was unreal in that it was surprising news to me. Now, it is just an estimate by an economist who works at Zillow.
Right.
But the headline says Zillow just got super bullish.
On these 37 housing markets.
Well, not only that, on
in
the
general,
entire United States.
Yeah.
When we started doing this podcast at the beginning in January, we were talking about appreciation. Well, it turns out that appreciation is still going on. And we're seeing it in the market because there's such limited inventory and
offers and
demand that houses are still getting bid up from their list price.
Yep.
Per your data at the beginning, we are over 100% list to final price. The final
List sales price ratio.
There you go. Is over 100%.
Yep.
So they came out and said, Zillow came out and said from April 2023 to April 2024, their chief economist, Jeff Zucker, I believe his name is.
Yep.
I'm pretty good at remembering this.
Yeah.
Anyway, he's predicting a 4.8% increase in home prices for that year from April 23 to April 24. Nationally, on average.
Right.
37 markets are predicted to increase 7% or greater in the market. In total, there's 400 markets that they identify.
Yeah.
390 of them are going to have positive returns.
Right. So you don't want to be in one of those 10 that's headed south. But
well, no, the point is that rates are high, and there definitely are affordability issues, and some people are going to struggle to qualify unless they start making more or figure out some way to do it. But there's still enough demand to drive these prices up. For those who are ready to buy, who can qualify, who think they're going to wait out the market and wait for lower interest rates to buy a house, is that house going to cost them more in the future?
It's certainly not going to be less.
All right. We've talked about homeownership as a way of building wealth. Here's a stat that jumped out at me, and I calculated the numbers. And this, Jeff Zucker's...
there's ZHVI, so there's Zillow Home Value Index.
Correct.
Yeah.
Since 2021.
No, 2001.
I'm sorry, you're right, 2001.
Yeah.
I'm sorry, for 22 years.
Yes.
I had that right. 2001, the average appreciation is 5.08%.
Which includes the housing bubble and collapse.
Right. So if houses jumped in value, that's the point I try to tell people when they talk about appreciation, because there's always years that it's going to go up a lot, and then there's flat years. And in a rare case, you do have values drop. Who knows if that'll happen? A lot of people predicted a drop because values rose so much.
Yep.
Post-COVID
Didn't
with low
happen.
interest rates. Didn't happen. Doesn't look like it's going to happen yet. But anyway, since 2001, 5.08. That's 22 years at 5.08. I calculated it's 2.927 times, almost 3 times the value of the house.
So you bought that $100,000 home, that's worth almost $300,000 now.
And that $300,000 house is going to be approaching $1 million in value if this continues in 2045.
Wow.
So think about that.
Yeah. Can you imagine?
That's pretty unreal. It's good.
is.
It's good for our business to value, because again, as values go up, those mortgage payments are going to increase. But if you buy now, guess what? You lock in your mortgage payment.
Yeah, your housing cost is fixed.
Pretty much fixed.
Yeah.
So,
Yeah. Beautiful.
anyway, that was unreal to me. I did think that there were going to be some, and I've been seeing it in the news that economists were going to adjust up the value of homes, or the appreciation of values homes, over the next year because of the limited supply and demand exceeding the supply.
Yeah.
As long as that dynamic continues, we will see appreciation. When it comes to demographics, I think that's going to continue because we have 2 huge populations, the millennials and Gen Z, who are forming families and starting to buy. Well, millennials have been buying homes for a while, but they're going to continue to buy homes. And Gen Z starting earlier than millennials did to buy homes. So
Yeah. Good deal. Well, that's the unreal, Michael. So moving right into the spotlight this week, as I mentioned, we've been fairly Baltimore City, Baltimore County centric for a while, and I thought that's just not fair. We need to spread out a little bit more. So, spot that I like in Westminster that is a really nice place to go. Rock Salt Grill. That's seafood, steaks, raw bar, tavern kind of place in Westminster, and it's just a phenomenal food. So they're at 65 West Main Street in Westminster,
Okay.
and you can reach them at 410-821-6400. They're closed Mondays, but Tuesday through Sunday Tuesday, Wednesday, Thursday, and Sunday they're open 11:30 a.m. to 10 p.m. The kitchen closes at 9. Friday and Saturday they're open 11:30 to 11 p.m. and the kitchen stays open till 10.
Makes sense. Most places stay open.
Yeah, right,
later.
for the weekend. Yeah, but their food is phenomenal. They've got seafood. Their seafood's really good. They've got a bunch of salads, some really good salads, but they've got lots of sandwiches, mahi-mahi tacos, a pork barbecue sandwich that's really good. There's a salmon BLT that's really good, shrimp salad, all that. But then they've got ribs, they've got steaks, they've got crab imperial, they've got New York strips and broiled lobster tail and filet and just honey glazed salmon. There's so many really good things there. I'd be surprised if you went there. You've got picky eaters in your family. Mm-hmm. It's a great place to go because
they'll find something.
They're gonna find something to go. So anyway, great place to go. Rock Salt Grill. So we'll feature them this week. 65 West Main Street in Westminster. Check them out. You can call them 410-821-6400. So, Michael.
Yes, sir.
That's episode 20.
We're done.
In the books.
In the books.
Yeah. Next week.
Frightening news.
Surprise. We're not going to tell you what yet.
Okay.
But we'll tell you what we're going to talk about.
Okay.
And I think it's a good session because we're going to be talking about, we've talked about buying, how you buy. We talked about how you sell. We talked about some loan products. This is about financially getting ready to buy, right? So it's preparing to buy, financial planning for home buyers. We're going to have a special guest come on, a phenomenal financial planner, and we're really looking forward to that episode because I think it's going to be great information for people and maybe some things that aren't so obvious that are great tips to help you get financially ready. So that's next week.
That's next week.
With something special.
Okay.
Yeah. But anyway, folks, thanks for listening. If you want to check us out, you can reach us on the web, www.berealpod.com. You can listen right on the site. You can also submit comments, feedback, tell us what you want to talk about. Let us know how you think we're doing, anything you want. You can also listen to us on any of the major podcast platforms, and we're on YouTube. All you got to do is search for @BeRealMDPod on YouTube. And if you would, great favor for us, subscribe, like, and comment. And if you know of anybody who'd find the information that we share useful, please pass that on to them.
There you go.
All right. So, Michael.
Yes, sir.
Somebody needs to reach you to get in touch for mortgage information. How do they reach you?
Call me on my cell phone. I have it with me at all times.
You do.
So does everybody these days. Anyway, the number there is 443-310-0012. Again, 443-310-0012. You can call or text. A lot of people these days do not like calling. Yeah. Text is fine. Just let me know who you are, where you heard from me, and I will get right back to you. If you prefer an email, you can always type in michael.becker@spmc.com. Again, michael.becker@spmc.com.
All right. So if you have to reach me, you can reach me at brad@homesbyvesta.com via email or via my cell at 410-375-7550. So again, that's brad@homesbyvesta.com or 410-375-7550. All right, so folks, listen up. Be ready for next week for our special surprise, but great content. It's going to be a lot of fun. And bear with us because it'll be interesting too.
Absolutely. Looking forward to it.
Yeah, absolutely. Michael, thank you for your time. And folks, thanks for listening.
Thank you.
We'll talk to you next week on the next episode of Be Real,
the Maryland Real Estate Podcast.
Thanks, folks. Bye.
Traffic.